Hey, and good evening, everybody. Ed Talaskis here, Random Walk Trading. It's Thursday, May 3rd. Hope everyone's having a good week. Market's finally getting some two-way action. Nice little move today, then back up, but we'll talk about that in a second. We'll do a brief. I had some issues with the text going out today, so apologize for that. So we're gonna go over trade 17D, which is expiring tomorrow, but we made a couple adjustments, or one adjustment in there today, and we'll talk about. And then we'll look for a new SPX weekly trade and go from there. So rain is on its way, I think on Saturday. So some of this pollen stuff will definitely help my eyes because it still feels like I got sand in my eyes, and it's just brutal. But like I said, from April 15th to Memorial Day is pollen season 101 for me. But like I said, just stay inside, take medications, and the taking the drops as well. The Zatador drops, I think they have. It's over the counter, but that seems to work pretty good. But it's tough because the medications and that typically have side effects of headache or sore throat, or you get the lightheadedness. I get that with the Allegra. It's just this real lightheadedness. I feel like I'm going to float away sometimes. But dog seems to enjoy it when I get that way because I'm usually laying down when I get the headaches and that, and he just conks out on my feet and cooks me to death like I need to, with this almost 80 plus degree weather that we got here in North Carolina. Crazy. Anyway, let's get our disclaimer out of the way. And as you know, Random Walk is not a broker dealer, nor investment advisor. This presentation is for educational purposes only. We don't know your situation and what level of risk is right for you, as we're not making any specific trade recommendations, as the risk of trading options can be substantial, so please be aware of all your risks before placing any trades. Actual P&L can vary and be affected by liquidity, commissions, and slippage. All right. And you'll get a link. And let's go in and look at the market action today. Looking pretty darn good. Bottomed out between 10:45 and about 11:45. We're kind of the lows of the day, and start churning back to the upside. It's a little bit of a reversal day. So we were down quite a bit and then kind of powered back, and ending the day only being down about 6 points at 26.29. Russell only down 8 points again, to kind of hitting a low toward 11 o'clock to about 11:15. That rough ballpark, but again recovering just like the SPX, and NDX also recovering, only to be almost unchanged, only down 1 point. We're down as low as 65.39 to rally back to 66.67. So, and looking at the trend wise, it was a slow. We're well above 1, and when we start pulling back about 11:45, when I start seeing this kind of trend where we start descending, that means the bulls are starting to come back in. And I also like to look at the VIX, as the VIX makes a high and starts slowly kind of inking down. It's usually a sign that potential reversal going on. And because the first thing to do, the option market makers are going to be bidding up prices, and they use the VIX to kind of help, as they manipulate it, but price the options. As people get protection, they're going to bump it up, and as they don't need it, they're going to start bumping it back down. And tick-wise, it ended up almost being flat, but we had some pretty wild swings. We're down almost 1,200 around the 10:30. Pretty bearish in nature there, but that's towards the lows. And then we kind of swung all the way back, almost hit 1,000, which is pretty extreme on the tick chart, around 1 o'clock. So pretty nice action there, and then the VIX actually retreated after going as high as 1866, and then pulling back a few points by end of the day. So with that, let's see. Before we get into Well, we might as well. Let me do the trade first, then we'll come back and look at the SPX. And this is trade number 17D that we've been talking about. And I canceled the put fly after we had the nice little downward swoosh, in the market. I'm looking at the chart. We broached the 2600 level, and as we go there, it's the next stop I think be the 2580 level. Didn't hit it, but the more times we test this lower level, and we bust through it, it could be good news for the bears. But as we kind of start broaching down here at the 2600 level, I canceled the put fly that we had on originally, and just ended up selling a 10-point spread. It wasn't 80%, but with 1 day left, try to ink out some juice. I got 330 credit on the 10 contracts. This is we got 10 contracts here on this one side, so that locked in about 3,300 bucks. So if we sit here, it's 32.65. Now at the same time doing that, it does bump up the margin. Try to keep under 10K. This is going to be 11,775, almost 12K. But for 1 day, under other circumstances, I might buy back some of this. I may do that tomorrow if we start heading lower. If I'm up to selling anything here, I'm going to be buying at least the same width, if not a little bit wider on the downside, just to help control the margin. But if we do get some kind of pullback, we still got a little window of profitability. And if we do run up to the upside, I forget, we got the was it the ADP or employment report to think tomorrow. So if we have a nice little move either way, we got something kind of waiting in the wings. We did get filled on the upside. Tuesday we talked about modifying this upside, and we did get filled on those two adjustments. We back it up here. So it's something like that, and we just kind of bought them back and got us a little bit closer. So we just moved the break even up to the 26.76 level. So moved it in, and it cost us 50 bucks to buy back the shorts, and another 500. So we spent 550 bucks, but it got us a little bit closer. But we didn't know that we're going to get a nice little swing to the downside. So that was the only adjustment that we did today. And like I said, if we start moving down tomorrow is expiration. If we land anything in here, we could sell another spread here, which is most likely is what I'm going to do. And like I said, if I sell anything here, I'm going to buy back some shorts accordingly. So that is 17D on doggy. Now, with that, let's take our unofficial poll here. And we've broke out of this little ascending or sideways wedge, so to speak. We've broke to the downside, bounced off the 200, came back up above it. Like to see a little bit more conviction to the upside, but so we've kind of breached a little bit to the downside. So like I said, we break, obviously the 2600 is a nice psychological level, but 2580 is the next layer of support. Weekly chart holding up so far, but again, it's testing that 10-week moving average in the weekly chart. Now on the daily chart, again, it's kind of bouncing here on the 200-day. What do you guys think of the next 30 days for the SPX? Up, down, sideways? And if you got a price target, type it in. And while you guys are typing that in, I'm going to fire up the dashboard. And James is asking what expiration. Okay, let's look at. Yeah, because we didn't do one last week because we did the Google Play. So it's the 25th, and the 25th would be second. Let's say June 1st. That would be the next Friday. Yeah, so we'll say June 1st. Between now and June 1st, where do you think the S&P is going to be? All right, that's what we got here. Sideways 2650. Okay. Down 2550. Okay. 2500. Okay. 25, then 2400. So I've got a super bear going on here. 2400 in. It's this layer of support there. So there's supports. We do some extensions. Interesting. A little bit of clusters going on. Lower. $2,600. All right, so it looks like the majority of you guys are saying lower, which is fine. Got 23% IV rank. So let's see what we can kind of construct here. And let's do this. Bounce it up. Let's look at our own favorite here. This I'm looking. We can look at 30 delta, 10 cents difference. We'll talk about that in a second. Yeah, that's a good point, Sarah. Yeah, employment reports tomorrow, so yeah, we could have some movement, which we'll cover here in before we kind of finalize things. But for the sake of getting something going here, so looking at June 1st expiration, paying attention to the 30 delta, and we're bearish, so that's at the sweet spot of our delta curve. And the 25, 80, 25, 55, 25, 35 is $2. So let's start with that. All right, so that's $1,000. Nice little potential play. Of course, got to finance it. And let's see, since we got $2, about 50. I'm gonna go roughly the same distance, 26.80. That's 80 cents. So a bearish risk reversal. So instead of selling a call spread and buying a put spread, we're buying a put fly and selling a call fly, or buying a broken wing. So also give some options here. That's 80 cents. Okay, I've got the extra strikes. I'm stretching it out here on the strikes. That's already pulled. And I'll let you guys pick as well. This one there. $1. And let's look at a simple spread. It's $1.50. All right. There's our call spread. That's not too shabby. All right, so let's back up a step and fix this. So we got the employment report tomorrow, I believe, at 8:30. We got William Dudley speaking, John Williams. So it looks like the big focus will be on the employment situation, which could move the market yay or nay. And we're not going to know that till 8:30, so we can get some swings in here, but we're going to take that in consideration. And as I mentioned before, looking at the average true range, this is the 5-day average true range, 32 points roughly. Today it moved 42 points, almost 43. So if I use a rule of thumb, say 30 points, plus or minus 30 points. Just making a side note there, and we'll use that in a second. So I like looking at that just to get a rough idea of the movement. Now also, if we break out of this sideways wedge, as I mentioned, the width of this could be where we kind of go the next step up or next step down, which could be a pretty significant drop. And having that in mind, we got our 2 standard deviation marked here at 2,400. So I think there's someone that mentioned about 2,400. So that'd be obviously a 2 standard deviation move. We had a little reversal today. We could continue to go to the upside. But let's start. Let's see. We got some options for the call side. Let's look at the put side as well. And let's see here. All right. All right, so let's just do the put side for a second. So we got a Venus. Oh, let me give you a third option before James mentions something. Whoops. See. See, 2580s are 30 delta. So let's do another butterfly here. But let's make this 2580, 2545. Oops. Turn him off. And that's 2515. It's 290. Yeah, so let's stick with that. 10, that's a regular verify. I'm just lifting it up. It's 350. Yes. All right. we'll stick with this guy for right now. All right, so let's look at these three. We'll get back to the call side in a second. So there's option 1, option 2, option 3. So we got a little bit of a caravan going on here. Probably let's do. Yeah, let's do this while we're thinking about it here. So I'm just writing down the strikes here, so I can go back to the dashboard for a second and kind of show you something. 35. And then we got the put spread. 2580. 60. 40. And then we got 2580. 45. 2515. Okay. It's a little bit bigger one. All right, so what I'm doing is we're going to look at each of these. So look at this first one. It's pretty basic Venus fly that we like to use when we're doing directional plays. So what we're looking at, let's go to the Venus fly section. So here we are, camped out for this guy. Now the average true range is roughly plus or minus 30 points. And each row represents a 5-point move. So if I go up, if we move up 30 points, if the market rallies on the news tomorrow, and I want to get a rough idea what the price of that butterfly is going to be, I'm just going to move down 1, 2, 3, 4, 5, 6. So roughly $1.50. So we go from $2 to 150. Now, of course, we need the market to rally, but at the same time, if the market decides it's going to go back to the downside, I go 1, 2, 3, 4, 5, 6. It could go from $2 to $2.60. Now, I don't know about you, but I'd rather get something, get a deal versus paying over retail. So the $1.50 versus $2.60 would be my vote. Obviously, a little bit cheaper. Now, let's assume for a second that the market does go down. Well, I don't want to pay $2.60, right? Well, what we can do is we just shift the butterfly that we normally buy. Instead of buying this guy, just buy the 2550, 2525, 2505, and it should be roughly about $2. And you just reposition. And now the thing that should help in that situation is if we move down, volatility will kick up. You'd have to readjust your strikes, for your strike selection, but you should get a little nicer risk reward because implied volatility should kick up as well, and especially if it's a large thrust. So from this standpoint, the price of this I'm going to put at $1.50 instead of the $2. So that will be this guy. Next up is the straight vertical, and that vertical is currently at $4.40. And I do the same thing here and just go up and down the option chain to see what the price of that spread is. And again, if we rally 30 points, maybe 1, 2, 3, 4, 5, 6, it'd be $3.15. And on a 20-point spread, your risk reward is going to go up because you're buying it at a cheaper price. And on a debit spread, your reward is the width of the strikes minus your debit. So if I pay $3.15, my reward is $16.85. So a little over 5-to-1 risk reward, which should be good. And likewise, if we do move down, and instead of buying this original 2580, 2560 put spread, I could just move down and buy the 2540, 2520. put spread if I need to. But again, I'm trying to find a good deal, and if the markets rally, or now this is just for rough government work. Now once the market's up and open, all bets are off. I mean, if I'm off by 10, 15 cents, I might go ahead and give in. But to have an order in there and have it queued up, could pay dividends. So I'm gonna put this guy at 315. And this is a bigger butterfly. I don't know if this will have that 2580. Yeah, it's a little bit bigger. So in this case, another rough rule of thumb, and there's a very rough rule of thumb, as we say, at least a 10% discount. So 290, 10%, roughly 30 cents. So 260. But I'm going to go back just a little bit further and say maybe 250. So a couple different ways to kind of price the spreads when the market's closed, and you're trying to formulate what would be your best strategy. All right, now we've got our prices kind of cooked up here. Now remember, the first one is the straight Venus fly. It's this light blue color. It cost you $750 on 5 contracts. We all start making money roughly at the same level, to 2580 level, and you get the risk is the initial debit of the spread. The second option is the straight, the red line is the straight put spread, and so it's like a black ops type trade that we're setting up for 315, starting at the same level, but you get a little bit more profit if we get a nice move to the downside. Now we're going to treat it as a black ops type of trade, so if we do get the move down, we're going to try to sell something against it and get in the trade for even money, or get, create a butterfly for even money, or potentially even a credit. And now that we got two-sided markets, we might do more of those. We did a bunch of these about a year and a half ago, and of course the market really didn't move to the downside, and it's like it was tough. But now that we got some swings moving around, black ops types trades are definitely should be in your tool shed of things to think about when the market starts moving. So that's the red line. That's 1575. So it costs a little bit more debit, but you get a little bit more downside protection, and you can sell something against it. But we can do it with butterflies as well. But first steps first. And then the last one, the tan line, is the bigger butterfly. A little bit cheaper. It comes at 1250. Start at the same spot. So you get a little bit bigger butterfly, and you get a little bit more to the downside. So of 1, 2, or 3, which of those do you like the best? Oh, can you show the prices? There you go. So 750, 1575, or 1250. Yeah, I hear you, James. We'll definitely cover that. Let's say 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 versus 1, 2, 3, 4. All right, so it looks like you guys like option 3, which is not a half bad. It's got a pretty nice butterfly with a decent chance. It's kind of the middle of the road type trade, but nothing wrong with that. Now, let me get rid of the other guys. So that takes care of the puts. So now let's do something, let's, again, I'm just making some notes on the call stuff here. So we got a 2680, 2695, 2720. And then we got a regular 132. 2720, 2730. And then we got the straight call spread. So again, I'm just jotting this on a piece of paper. Low-tech solution here. And we do the same thing. So let's start with the call vertical. Again, just going to look at the option chain here. So there's our 2720, 2730. And again, if the market rallies, we can increase 1, 2, 3, 4, 5, 6. So that could be about $2.80. So that almost doubles the credit spread. Now remember that when it does go up, IV is going to drop, so that's going to hurt a little bit. The second thing is it's a wider spread. It's a 10-point spread, not a 5-point spread. So there'll be a little bit more of a collapse in volatility from a Vega perspective. But likewise, if we drop 1, 2, 3, 4, 5, 6, if we drop 30 points, that spread becomes 68 cents. And I'm not interested in selling a 10-point spread for 68 cents because my risk on each of these spreads is going to be the width of the strikes minus the credit received. So on $10, I'm risking $9.32 times 5 contracts, which is be significant. So in this case, I'm probably going to let it, let's see, we get to 150. So I may say 280. I'm going to say maybe 250. I'm going to be a little bit, I was thinking more lenient, but again, this is just up to your discretion. If you want to go for the full 280, it's fine. And I'm going to try to go for the 250. Because if we do get some kind of rise, the vol is going to come out and the price of these credit spreads are going to drop as well. So that'll be detrimental in trying to sell the spread because the IV will be coming down and the spread value will be less. Now, of course, we don't know what's going to happen until the market opens, but so 250 on the credit spread. Now, the other thing, if we look at the other option that we got a 132 fly, which is the 2710. Here we go. Where did you go? Where'd you go? Where'd you go? $27.10, $27.20. There you go. $27.10, $27.20, $27.30, 132. Currently at $1.05 is $1.10 a second ago. Again, do the same thing here. So we go up 30 points. If the market goes up 30 points, it'll be 1, 2, 3, 4, 5, 6. Becomes 225. And likewise, if the market drops, we're going to lose that premium, and it's going to be 1, 2, 3, 4, 5, 6, about 50 cents. Still decent, but we're trying to use some of this premium to help pay for the put butterfly that we're trying to buy. So 225 would be probably a good one for that one. And then lastly, we got the regular broken wing, the 2680, 2695, 2720. Again, if I go up 1, 2, 3, 4, 5, 6, it's 220. I'm going to say $2. Again, IV will collapse as we kind of get up. And likewise, if we go the other direction, I can get less credits. But if we do drop, I can also move these down as well, and then reselect my strikes. So we got the prices on the call spreads now, or the call options, or the things that we can do. So 80 cents, I'm going to put it to 220. And then we got the regular, like buck 10 be 225. So again, being aggressive with the entry because as traders we want to get some kind of edge. The market makers are stingy enough as it is. So we're just trying to play a little chess game here. And then the straight spread 250 or 150, we're gonna go to 250. All right. So if I queue these up, now in the case of the call side, we're trying to make this expire worthless because we don't want to be in the money. Well, we could if we were in one of the butterfly options, but we're trying to use the credit to pay for the put side, but we also got potential risk here. And as you can see, the first one, which is the regular, the blue line here is the regular broken wing butterfly. Start making money at 26.80, and then the upside break even is at 27.12. It's the lowest or the closest of the three options. So you do receive a credit, but you do have a risk around 3,900 bucks. Next up is the 132, which you almost get the same amount of credit, and it's the red line here. And your break even goes from 27.12 up to 27.25, which is a good thing because you want to get as much wiggle room as you can, and we're receiving the same amount of credit, and we've got almost the same amount of risk. The trade-off is your profit window is a little bit smaller because it's a 132, so you got an extra short in there. So this area is obviously, smaller than the call broken wing butterfly. So that's option number 2. And then lastly, we just got the straight call spread. You collect about 12.50. Again, almost the same amount of monies, and it's kind of in between the first two, with about the same amount of monies due. So, as far as 1, 2, or 3, which one do you guys like the best as far as to pick to help pay for the put side? 1, 2, or 3? Yeah, it's pretty much unanimous. Yeah, option number 2. Basically get the same amount of credit, same amount of risk, but your break even is the furthest out to 27.26. So we will look at that guy. So let's get rid of the other ones. And turn him off, and then see what we got left over. And let's put this guy back. And it costs us $1.25. I can live with that. And we got about 51.25 a risk if we had filled on both. So that takes care of the first one. Now, the other thing is the trade. Duplicate it. So now I want to. So that's going to be our initial position, and then I'm going to look at maybe a stacked fly for the downside. And let's see what we got here. 25, 45, 15, 30, 35. And pretty enough for government work. All right. So what I do, we're going to be a contingent order in essence here. So once we get filled on this position, what would be the next step? Well, next step would be, or what we could do for potential adjustment. I'm looking at the put fly here, currently 85 cents, so $850. But if we rally to the upside, the price of this butterfly obviously will get cheaper, and maybe for potential, say 25 cents. Being aggressive. Now it cost me $250, but if you notice, see what happens to our put side when we stack the butterfly against the first butterfly. We get a pretty nice bigger butterfly, and you look at the risk down here, it's only $2,900. Not bad for a $250 investment, but we need to get obviously a cheaper price. Now the other thing that could happen is if IV increases, if we get some kind of move to the downside, that'll make these 25-15s a little bit more expensive, which should make the price of the butterfly a little bit cheaper. So that could be our contingent order once we get filled on the original put fly. Now on the upside, to help get rid of some of the, if we want to do, let's see, we'll look at a couple of different things here. So obviously on the call side, it's a butterfly. We could buy a spread. We'll look at both of them. So here, we got a couple. We can buy the same strike here, or we can kind of try to grow the long leg. So that'd be what, at 2,700, 2,710. So that's currently $2.35 times 5 is almost $1,000. So we can have an order in here, maybe for $1, spend $500, and we get something like that, which we go from almost $5,100 in risk to $625 with a $500 investment. Seems like a pretty good deal to me. That could be one option, and the other one is I always like to keep the butterfly friends in hand, and maybe we do a stack. See if we can do a stack fly on the upside. I could do the same thing here. Oops. And in this case, see 2720s, 730. Looky there. Let's see, right off the bat, you spend $1,000 here or $850. Now, granted, this is a higher probability trade because I'm adding a stack fly further out of the money, so that's why this is cheaper. So it's not all we've seen. But if we get the market to cooperate and maybe try to get this on for a quarter, we can get some nice little thing here. Now, this doesn't look like much, but that's still 5K. That's $4,600. That's nothing to sneeze at. You can take a nice little vacation for, what is it, $4,600? Fiji, Bangkok. We can visit K. Go to Australia. So there's a couple options. So we can set this up as an OCO. So, so I think we got everything that we need to get things cooking here. So we got some aggressive pricing on our orders. We got our contingent orders ready. So let's go ahead and queue this up. Create typical order. And we'll say first triggers OCO. So I'm going to put all this in as one big order. And there we go. Make these GTCs. And the first order, like I said, I do this because I don't want to get some wacky prices. I'm going to wait till after the first hour. If you get a better price before the first hour, good for you. Send me a postcard. So after the first hour, we'll put this in. And then For these guys, you see with the call spread, we're willing to do for $1. And we're willing to do the second one for $0.25. And these are arbitrary. You can pick whatever price points that you feel comfortable with. But we got an aggressive price. We got our 2 orders. So once we get filled on the first, these 2 go live. Whoever gets there first, I really don't care. One costs a $500 adjustment. It's a higher probability trade. The other one's $250, but we eliminate $5,100 of risk. So pros and cons. So that this will be 23 D as in dog, 24 D as in dog. Yeah. SPX 1 June. So there's our call side. And the put side is just going to be the simple order. First triggers all. And again, I'm going to put this after the first hour. And it goes in. So once we get filled on the puts, then the stack fly goes in for $0.25. And if we get filled, then we'll have a pretty sweet trade set up. All right, so that looks good. Let me save this. All right. So as a quick recap, once we get filled on both sides, we're looking to try to get filled on the put spread, which should be a stacked fly. Get a nice little setup there. If we get a rally and then we get some kind of major pullback, we'll be sitting pretty. Likewise, if we get some kind of flush to the downside, we'll have a better chance to get filled on the call spread for $1, which would raise it up. Or we do a stack fly, and that just kind of just levels out the risk, but we get a nice little pocket here. But you can see as we get more IV, you can see the butterflies get a little bit bigger, but there's more skew on the put side, so that's why we're seeing a little better risk reward and some nice little juicy little butterflies. So that is it. So, all right. So hopefully that gives you an idea of what we got lined up for tomorrow. Back on Tuesday, we'll review our open trades. And the rain will be in over the weekend and help clear up some of this pollen so I can at least sleep and breathe better. And we'll go from there. But if you got any questions, shoot me an email. Otherwise, I will post the fills as they get in the trade room. And if you get the SMS text messages, you should get that. I'm assuming they get this fixed by tomorrow. Other than that, have a good weekend, and we'll talk to you guys on Tuesday. Thanks.